Good morning, good afternoon, and good evening to all our members and our guests who are joining in West Africa's Ethiopian Birr Flotation webinar today. I'm Chantal Carrington, CEO of Invest Africa, the leading platform to drive sustainable investment into Africa. I'm delighted to also welcome our distinguished panel with Barkat, Patricia, Duncan, and Zabadene, who is also on our Invest Africa Advisory Board. Today's webinar will focus on the Ethiopian Central Bank's decision to introduce a floating exchange rate and to debate what the immediate and medium-term effects for investors and businesses will be, whether they are already operating in Ethiopia or looking to set up in Ethiopia. We will be discussing how this is expected to reshape the trade and investment landscape, influence foreign exchange dynamics, and affect inflation rates. We will also consider the broader economic repercussions, including potential growth sectors and shifts in trade balances. This webinar is part of our content series hosted in partnership with Crown Agents Bank to explore new insights and understanding around the role of FX and payments in African economies, as well as the integral role that payments and FX will play in realizing the ambitions of the African Continental Free Trade Agreement and future trade and investment. At Invest Africa, we recognize the pivotal role that payments infrastructure plays in driving economic growth and investment across the continent, enhancing financial inclusion and enabling businesses to thrive in Africa. So on that note, I'm going to hand you over to Barkat Tekel, who is the head of Central and Development Banks within Emerging Market Financial Institutions at Crown Agents Bank, to chair this distinguished panel. So please remember to use the Q&A function as well as this webinar progresses. But for now, Barkat, over to you.
Thank you very much, Chantal. Being of Ethiopian heritage and working at Crown Agents Bank, which specializes in emerging markets, it's a unique honor for me to moderate this important discussion on Ethiopia's historic recent currency reform. In terms of format, we'll aim to spend the next 30 minutes engaging our expert panelists, who I'll introduce shortly. We'll then leave about 5 to 10 minutes towards the end for a Q&A. So as Chantal mentioned, feel free to pop in your questions in the Q&A box, and we'll try to address as many of them as we can towards the end, if not individually, thematically. So without further ado, let me introduce our three distinguished panelists. From ICAP Africa, we have Duncan Keel. Duncan is the CEO of ICAP Africa. He is, ICAP is part of the TP ICAP group, which is listed on the London Stock Exchange. The group is the world's largest interdealer broker and a leading liquidity and data solution specialist. Duncan has also worked extensively in Africa and lived in South Africa for several years. We also have Zamarina Nagatu, global chairman of Fairfax Africa Fund. Fairfax Africa Fund is a US-based investment fund that has invested tens of millions of dollars in Africa across infra, technology, and real estate sectors. Prior to his current role, Zamarina was the founder and managing partner of Ernst & Young Ethiopia for more than 18 years. And finally, certainly last but not least, we have Patricia Rodriguez, who's the Associate Director at Control Risks. Control Risks is a global risk consultancy that helps businesses navigate complex and uncertain environments by providing political, operational, and security risk analysis. Patricia is focused on Eastern Africa and covers clients across a range of sectors, including finance, natural resources, and international development. So now we can move on to the meat of the discussion. So before perhaps diving in, we can do a bit of a scene set. So just for context, after decades of rapid public investment-led growth, Ethiopia has faced significant headwinds in recent years, from domestic challenges to global shocks. Ethiopia is now at a crossroads. The government's bold decision to float the birr signals a major shift towards a market-driven economy with the potential to enhance longer-term stability and unlock new opportunities for trade and investment. In that context, let me turn to you, Patricia, to kick things off, if that's okay. And of course, Zamadina and Duncan, please feel free to jump in as needed. But just to get things going, what does the flotation of the birr entail, and what are the immediate impacts on the exchange rate and on market reactions? Patricia, over to you. Sorry.
Thank you so much. So yes, briefly, it was a historic decision to float the birr, and what that entails is that the central bank, the NBE, will no longer intervene to set the certain rate at which businesses can obtain foreign currency. So for the longest time, as you mentioned, Ethiopia was a state-led, state-planned economy, which meant that the government also had quite a tight control over foreign currency. And this was so it could allocate foreign currency to specific projects that it thought were of national importance. So now that foreign currency exchange rate set by the government is gone, and market participants are better able to determine at what rate they should be exchanging on a kind of one-to-one basis. That doesn't necessarily mean that the government won't intervene. It has said that if it feels that the exchange rate is perhaps too volatile, it can intervene in the markets, for example, to either buy foreign currency or sell it, depending on where the currency against, the birr against the US dollar exchange rate is. What has happened in the aftermath? So in one day after the announcement of the reforms, the birr actually lost a lot of its value, about 40%, and has actually continued to lose quite a bit of its value. This has prompted a bit of concern, especially amongst local participants, so local citizens in particular, who are now very much concerned about the impact of this devaluation on their ability to source imports, for example, but also on the wider impact on inflation. So the immediate impact has been really to devalue the currency, and we're starting to see the potential for inflation to increase. I do want to highlight here that one of the main things that the Ethiopian government was aware of and concerned about was this impact on inflation. And so in advance of this, the government had been in negotiations with the IMF and the World Bank to make sure that they would be able to intervene to cushion the effects of inflationary pressures. And so we saw almost immediately the IMF coming out and saying they had agreed this $3.5 or $3.9 billion support package to help the government cope with this rising inflation. Essentially, what it's intending to do is subsidize certain food and fuel imports for a little bit of time to allow the market to stabilize and to make sure that people's incomes aren't too badly affected by the depreciation of the currency.
And Zamadina, I think I see you. You're not on mute. Did you want to chime in on that, or should we?
Sure.
Yeah.
Okay, can you hear me?
Yes.
Excellent. So listen, first of all, thank you, and in West Africa, congratulations for organizing such an event. I think the focus lately has been on the dramatic change in policy regarding the flotation. And that is definitely a big policy change. I mean, it happened the first time in 50 years. But I think what I want your audience and the listeners on this participants on the webinar to understand is this is actually part of an overall economic transformation of policy that the Ethiopian government has been implementing over the last 4 or 5 years. This should not be seen as an isolated event. For example, the government has introduced what's called the Homegrown Economic Reform Program over about 4 years ago, with multiple pillars, anchoring the economy, manufacturing, agriculture, ICT, tourism, and natural resources. What that entailed was they wanted a transformation of the economy. As you know, over the last 15 years or so, the economy, the growth has been driven, as you did in your intro, by CapEx and government expenditure. But like any other, growing economy, transition was needed. And so we went from a state-led economic program or philosophy, very similar to early days China, very similar to early days South Korea, to now where there's going to be a handover to the private sector. So there was a need to transform the economy structurally, not bits and pieces. So when we talk about today, our main topic obviously is the currency. We need to keep that in mind, and also some context. And you obviously are very familiar with it. Maybe some on the webinar may not be aware of it. The Ethiopian economy today is the 5th largest in Africa in terms of aggregate GDP, and 3rd largest in sub-Saharan Africa. Only Nigeria and South Africa have a bigger GDP than Ethiopia and sub-Saharan Africa. So to not reform the currency regime will be out of step with the growth of the economy. As you know, 20 years ago, the Ethiopian economy was about $10 billion. It has grown by 1,900% over the last 20 years. So the baggage that came along with it, with some of the old legacy policies, needed to be changed. And I think the currency is one of the main drivers. But the opening up of the economy as well needs to be factored in as to why these policies were needed. I mean, for example, if you look at telecoms, Ethiopia was one of the first countries in Africa to introduce telecom 100+ years ago, but it's only in the last 3-4 years that the sector was opened up. And look, today there's vibrant competition between the incumbent Ethio Telecom and Safaricom. The same thing, the foreign banks have now been allowed to enter the Ethiopian market, okay? The retail wholesale. So there's a lot of reforms that is happening. So I just want to make sure that there's context when we talk about why the liberalization of the currency is happening at this time.
That's great. Thanks for the additional context there, Zamadina, that this is not just strictly speaking about the FX rate liberalization, but really the broader context and the transition that's been taking place structurally in terms of the structure of the economy. I want to bring in Duncan, if that's okay, just to maybe talk about the impact the flotation will have on private sector investment. So just to dive in, how will the flotation of the Birr change FX reserves and policies, and what will be the impact on businesses and organizations moving money in and out of Ethiopia? Duncan.
Firstly, I don't think there's any coincidence that 3 of the biggest 5 economies in Africa have all liberalized their foreign exchange regimes to some extent in the last 12 months, actually. Egypt, Nigeria, and Ethiopia have all done this. Ethiopia being the last one, and in some way incentivized to do so by the IMF. You can say, you can argue in both directions, but I think the most important thing about a liberalized foreign exchange regime is it should lead, it does not necessarily, but it should lead to greater liquidity. And if you want to do business in Ethiopia, you want to get good returns for your shareholders. If you're an investment fund, want to get good returns for your investors. But if you've got those returns stuck in Birr, and the only way you can get them out is at an unrealistic foreign exchange rate in dribs and drabs, you will pretty soon stop doing business there. A lot of our clients had to put brakes on their growth in that country, or stop doing business altogether, because they build up such big reserves of Birr that they can't move, that they have to stop. And let's be clear, these aren't profits that they're holding there. These are service fees for things sold that they probably owe to other people, or they owe back to their funders or to loans. So it's incredibly important that liquidity is freed up. And sadly, simply liberalizing foreign exchange markets doesn't guarantee more liquidity. Ethiopia still operates, unfortunately, a huge trade deficit. And until that changes, and until the levels of borrowing, in fact, in Ethiopia, the levels of foreign exchange borrowing, of dollar borrowing, is not so high. But the trade surplus is the worrying bit. And the inflation caused by a liberalization is likely to see a little bit of civil unrest as well. You know, these are brave decisions by governments. Nigeria was the first to do that in sort of June 23. It is a very brave decision because it's going to be hugely unpopular locally. It's short-term pain, hopefully for long-term gain. And it's the first step in Ethiopia really towards liberalizing. Then the banking sector needs to be liberalized, and there needs to be the establishment of liquid capital markets. So I think it's an incredibly positive thing. It's a very exciting time for Africa's big economies, but there's a long way to go.
No, I think that's thanks for sharing those views, and I think that the summary, sort of short-term pain for long-term gain, is quite good. I want to sort of we'll come back a bit to some of the things you said, Duncan, in terms of some examples from other markets in Africa that have liberalized. But before we do that, I want to pivot back to Zamadina and just basically understand a bit better which are the sectors that are likely to benefit and which ones are the ones that are likely to suffer following this change, Zamadina.
Very good question. I mean, and this is one of the things people have been asking is there's a table that says winners and losers, right? The big losers are the ones who are arbitraging the big currency arbitraging between the official rate that was 58 and the parallel black market that was about double, right? Which was depriving the country of the currency it deserves to get, right? So now, because almost today, if you look at it, I mean, one of the interesting things that happened in the last 2-3 weeks since the announcement of the liberalization of the currencies, we have now daily updates of currency rate by banks. And that gives you the dynamics that is going on in the place. So the loser will be the ones who are not adding any value to the economy, that are depriving, for example, remittances. I mean, there was a very significant amount of remittance that was coming through the parallel market. None of that FX was landing in Ethiopia. It was being exchanged overseas. So that they would be big losers, right? Those, again, who are not adding value would be the winners would be, for example, exporters, those who operate in the official market, and those who now need FX and can get it from the bank. Because, one of the big advantages, I mean, I think Duncan was saying that, well, he expects some, issues coming out of it. I think he used the word civil unrest, which with all due respect, I tend to disagree with that. Because remember, Ethiopia received the largest amount of financing from the IMF and the World Bank ever given to a sub-Saharan African country, which is $20 billion. So if you factor that over the next 3 years, that's about, and then add on another $5 billion from debt relief, we're talking about $26 billion over the next 3 years. That's about averaging $8.5 billion a year of liquidity, additional liquidity that comes into the marketplace. So I think it can cushion the inflationary pressure, but also gives liquidity to foreign investors who want to remit dividends, domestic investors who want to import raw materials and equipment. So yes, there's some, during any transition you have uncertainties, but I wouldn't expect any huge things. I mean, I spent many years in Latin America, in Brazil and Argentina. We've seen it. One got it right. Argentina didn't get it right. I mean, Brazil did get it right, and it was using its currency as a competitive tool. And I see Ethiopia as it migrates towards a value addition economy for this kind of policy to give boost. I mean, for example, I'm going to be frank with you. We are in the manufacturing business. We have a very large manufacturing plant in Ethiopia that exports 100% to the European market. Our retention, our dollar FX retention now has been increased to 50, and we're now being promised we can retain up to 100% of what the FX we bring into the country. So this gives confidence to foreign investors. I'm not trying to minimize some of the sort of the humps that we may face in Ethiopia as this thing gets embedded into the economy, but nothing out of the ordinary. And there are toolboxes to managing anything, whether it's inflation or shortages. As you know, the national bank, the central bank, has introduced an auction, an FX auction, to stabilize the market. So these are new, but as we go along, I expect over the long X number of months and years to a stable FX market that encourages FDI and domestic production within Ethiopia under the theme called Made in Ethiopia.
Lots of active debate and going back and forth, which I think is exactly the point of this webinar, to really see the different viewpoints and nuances. We touched on risks, so it's probably a good juncture to loop back to Patricia in terms of the geopolitical side of things. So just looking ahead in terms of the political and economic implications of the policy reform, let's say over the next 5 years, and as much as one can do that. What's your view or control risk view around projections for Ethiopia's economic growth and stability looking ahead, and what are the key factors that will influence long-term investment decisions, Patricia?
Sure. So on the kind of stability front, I tend to agree with Zamadena on the potential for these sorts of reforms to be hugely unpopular and therefore cause civil unrest. In other contexts, I think that's a more likely outcome. In Ethiopia, that's less so of a case. It is a bit of a different political institutional environment. and things like civil unrest in relation to economic issues haven't really taken place in as much as we've seen in other contexts. Having said that, I'm Kenyan, and so next door we always see what happens whenever there's unpopularity in economic reforms. We've had a series of protests in Kenya around potential tax increases. So we are seeing across the continent, young people in particular being quite upset about how governments are implementing economic policy issues. So there is potentially a risk of unrest coming up, but I don't think it would be destabilizing in any kind of way as we've seen in other contexts. So that's on kind of the unrest side of things. On the more political stability question, we have to take into account that it will be very, very painful for the individual citizens and the individual households. So from that perspective, there is the potential for economic reforms in the short term to foment anti-government sentiment. But we are also operating in a context where the ruling party, the Prosperity Party, does have quite a strong base of support across the country. And frankly, opposition parties don't really have the ability to mobilize any kind of stability threats at this point in time. Also, just to highlight that we are quite some ways away from an election. So by that view, this is a good time to introduce unpopular reforms because we're not facing an electoral test until about 2026. So from the political stability front, again, we are going to see some anti-government sentiment rising, but not necessarily posing a threat to overall Abiy and the government. On the economic front, I think that's where a lot is in question. Duncan mentioned the trade surplus being a really big problem in Ethiopia. And honestly, the liberalization of a currency is only one step in helping to address that problem. Just for a bit more backstory here, essentially we've come to this point with Ethiopia because they had a shortage of foreign exchange and we're trying to renegotiate external debt at the same time. All this is happening because the income that it's getting from its exports, the forex that it's getting in its exports is not enough to cover what it needs to import. And so that balance hasn't changed just because the currency has been liberalized. That balance will take time. It will not take months, probably years to actually be able to, get the export-import income even remotely kind of meeting one another. And yes, Zamadan is right. There's a huge package of economic support from the World Bank and the IMF, but a lot of that, as I mentioned, will take time. It's not going to be an overnight miracle in that sense. So there will always be this kind of imbalance. We have some multilateral support to help cushion that, but ultimately the economy itself needs to go through a huge structural change, and that is going to take several years to do. So just to highlight some of the key issues that we are foreseeing on the economic risk side, one is capital flight has already happened. So we're in a position where if we were in 2018, for example, and this liberalization had occurred, I think there'd be a lot more foreign investor interest in trying to get into the Ethiopian economy. There was a lot more optimism at that time. But between 2018 and 2024, we've had the COVID pandemic, we've had the Russia-Ukraine crisis, we've also had the Tigray conflict in Ethiopia. And those kind of broader political and geopolitical issues have already unnerved a lot of foreign investors. Foreign investors like predictability. They like to know that their money is saved today and it will be tomorrow, but that's not quite being seen in Ethiopia at this point in time. Yes, they may come back, but one alarming statistic, for example, I saw was that in 2018, there were over 600 Chinese companies operating in Ethiopia. That number apparently is around 120 now. So the capital flight has already happened. And now we're in this position where Ethiopia has to do this major marketing across the world to pull people back in. So Zamadan's mention of Made in Ethiopia, that might have some positive impact, but there is going to be a lot of work that needs to be done. The second one is around the backlog of foreign exchange. So under the previous regime, you had to essentially be put on a list to apply for foreign exchange allocations. Depending on what the government priorities were, they would then decide who gets the foreign exchange allocations. So as we mentioned before, state-led economic growth, a lot of the state investments were getting priority. Next on the list was food and fuel imports. But if you're, for example, a horticultural farm needing to export flowers, yes, you will get your ability to export, but you also need to import very basic things like cardboard boxes, rubber bands to tie your bunches of flowers together. Cardboard boxes and rubber bands are not on that list of foreign exchange priorities. So you have this sort of mismatch where, yes, you are an export-oriented business, but you actually can't import a lot of things that you need to do business. And so there is that backlog of things on the list that are still requiring Forex allocations that hasn't been cleared. I'm not entirely sure if the government has articulated how they intend to clear that. And so there's still a lot of uncertainty amongst local businesses about how that's going to be achieved. And the final one, before I pause this bit of a rant, is exactly how these things are going to be implemented. It's all well and good for the NBE to say this is what we're going to do, but if you're transporting goods and you meet a border guard who will just ask you, have you got your right documentation in place to allow this import or this export? That transference of policy at the top to the actual practicalities of the civil service and the people who are implementing these reforms, I don't think historically in Ethiopia hasn't been very quick. So it's known across like the regional peers to be quite a bureaucratic institutional setup to deal with. And so while you have all these executive level commitments, the people who are implementing things, you still need to get a document stamped 300 times before you actually get your allocation. So I don't know if that cultural shift will actually support a quick implementation of the reforms. I'll pause there.
Masterfully done, and yeah, really picked apart both the risks and some of the potential bright spots in the future. Zamadina, I think you wanted to jump in. Did you want to comment on that?
Absolutely. I mean, listen, we're financial people, so we use data points to interpret trends and realities, right? I'm sure Patricia has some data points that she's used, but let me elaborate a few things very, very quickly. Yes, there is a transition period. Of course, the economy is transitioning, and they, as I said, could face some bumps. But let me give you some example. FDI, foreign direct investment, okay? Because Patricia mentioned about capital flight. If you look at the last 5 years from the UNCTAD report of foreign direct investment in Ethiopia, Ethiopia has been in the top 5 years in a row, 3 billion plus every single year. So I'm not really sure that's as alarming as it may have been presented. Yes, we need to address the needs of both domestic and foreign investors, but the fact of the matter is investment has been coming into Ethiopia even during the past 4 years, which has admittedly been a challenging years with COVID, the internal conflict in the northern part of Ethiopia, which has been thankfully been resolved through the Pretoria Agreement, and some of the current ongoing issues that we face. I think they'll be behind us. I think the wind will be behind us because I tend to look at it beyond the here and now. Okay, as an investor, you look at the reform. So the issues that were being raised or the points that were being raised, some of them are legacy issues, historical issues. While we do face some issues without denying them, but I think the upward trajectory, the upside for investors, and the reforms. Let me give you an example. We talk about inflation, right? Inflation has been structurally high in Ethiopia for the last 15 years, averaging about 15 years. One of the reasons inflation has been so high is because of the very inefficient wholesale retail distribution system, which has been protected in perpetuity. now that has been open for investors, for international investors to come in with their efficient systems and their capital. So the banking sector, I think I mentioned earlier, we're going to have very competitive, a consolidated banking sector, which at the moment, there's only Ethiopians who are allowed to be in the banking sector. So when you, as the opening up of the bank, one other thing, by the way, I wanted to mention when you talk about foreign investment in Ethiopia, as you know, that the stock market is going to start operating in November. And I sit on the board, and that has been approved that portfolio investment will be allowed in the stock market, which is a big plus. Foreign investors who are not coming through the FDI window can come in through the portfolio window. So this liberalization, for example, of the exchange of the currency, the opening up, the availability, increased availability will also attract. Because remember, at the end of the day, the fundamentals that drives the Ethiopian economy continues to be attractive. There's no question. If you look at the IMF's, the World Bank's forecast for the next 2-3 years, they're looking at about 7% GDP growth. We think it could be 8 to 10% over the next 5 years. So we need to look at, separating legacy issues, which is being resolved through reforms, because we invest here. We as both as a fund and also as our private operators, we invest in here because we look at the long-term trends. So I don't want us to be, hanging up on focusing on what looks like alarming issues from legacy data that we pick up. Okay, I'm not sure where that Chinese data came from, but if you look at the UNCTAD report, China continues to be the single largest foreign investor in Ethiopia. So these are the kind of counterpoints I want to highlight without minimizing what Patricia and Duncan have been saying, but also enlightening the audience about the facts on the ground and some of the data points that we see.
Well, thanks, and I see Duncan's unmuted. Duncan, I was actually going to come to you next, so maybe in your response, you can hopefully layer this in as well. And maybe you're going to dovetail into this anyway, but we talked about this earlier, which is potential lessons to be learned from other countries, particularly in Africa, that have undergone similar liberalization. You mentioned Egypt, for example. Could we put that to you in terms of what lessons Ethiopia can learn from these experiences, in addition to whatever you may have already wanted to respond to the earlier question?
Yeah, I was going to use a fairly poor analogy about putting a plaster on a gaping wound, but it would be good to see some joined up thinking here between the IMF and Afreximbank, for instance, stimulation of trade, intra-African trade, and turning African economies into processing economies so they're not dependent on raw material and commodity cycles. Would be an incredibly positive thing to do. Simply taking aid from or money from the IMF in order to service debt or to act as a suspension unit between inflation when you devalue is a very, very short-term benefit and doesn't address the structural problems there that we all agree on, that the trade deficit is a major problem. I mean, people invest in Ethiopia because they see the growth there, and Zem is absolutely right. The projections are sort of 6% at least a year up until 2030. I mean, these are fantastic. You don't see that many places in the world these days, and that's what makes Africa such an incredibly attractive investment proposal, provided you address the risks and provided you're incredibly realistic about the problems of getting your money back out again once you've made good returns. But yeah, I think there's a tremendous opportunity there to invest in processing industries, to stimulate internal demand in the African Central Free Trade Area, so that you don't necessarily have to sell your products offshore for dollars in order to get the best value. It will take time to do, but I really see that as the investment opportunity, and a lot of our clients see that as well. It's just they need to know that they can get the money out, and capital markets will really help that, and so will liberalization of the kind of allowances around doing business there.
That's good. And then just touching back to, I know it's early days if we take Egypt, for example, but I don't know how closely you've been monitoring that situation. But any lessons to be learned that could apply to Ethiopia in that regard, in terms of effectively managing the transition?
I think sadly it's a little bit early with Egypt, to be perfectly honest. I mean, that was cushioned by a huge investment from UAE as well. I believe $35 billion was promised over a period of time as an investment in various sectors of their economy. I think Nigeria is probably better to look at. They tolerated, the Nigerian central bank tolerated without endorsing the parallel markets for a long period of time, because frankly, if they closed them down, they would have stopped any growth in the economy and closed down a lot of businesses. But now that you've got willing buyer, willing seller in the FX market, I think people are recognizing again the same kind of potential in Nigeria as there are in Ethiopia. It's just, it really does need to settle, and the FX rate in Ethiopia is not at the parallel market rates yet. That was above 120, even a little bit higher at occasions. It's not there yet, and the dollar liquidity isn't there to satisfy demand in any case. So it's gonna look at Nigeria in the last 12 months. It's been trading anywhere from 1450 up to 1700. I mean, that's huge volatility. By the way, there's just one other thing I wanted to say, which is really, really important, is that companies doing business in these countries, if they are marketing to market their portfolios at central bank rates, they will get a horrible shock by the time they actually have to repatriate these funds. They'll have to write down 40 or 50% of the value. And, you know, knowing the real value, we work with a company called Panellists. They do our morning reports. And in that, we track the difference between the parallel market rates and the central bank rates. It's really important to know this, because then you can mark to market your portfolios at a realistic value.
Understood. So just maybe we're approaching sort of the tail end of the conversation. So one more to sort of across the panelists, and then we'll pivot to Q&A shortly to allow the audience also to put their questions to us. But maybe I'll put this to Zem to kick things off, and he's already spoken to this in various parts, but just in terms of the macroeconomic impact for attracting FDI, it's been touched on throughout. But Zem, in your view, you know, how do you see investor confidence sort of evolving in Ethiopia? You know, now following this change, and again, you know, you touched on some of the different sectors that might benefit the most from FDI, but just really maybe just summarizing and putting out there your position on kind of how investor confidence will be impacted both near term and longer term as a result.
Right. So two things. One, obviously, it's a big boost of confidence. It's a process, I agree. But one of the key questions any investor asks when you put, you know, your standard investment banking spiel to a potential investor, you show them all the pluses, the IRRs, and everything. And say, okay, Zem, can I get my money out? I mean, that's always been like a key question. Now, I think that is starting to be resolved when you have liquidity in the market. As I said, listen, 8.5 billion additional FX in the market every single year for the next year, averaging it out, I think should give people confidence. Okay, so that the availability and the retention. If you are allowed to retain 100% of your investment, I think that also gives you confidence. But also, remember, investors look at long-term trends. Ethiopia has always been very attractive. For the last 20 years, has been very attractive to long-term investors. Okay, it was never a PE market. Let me be very clear. You never came to Ethiopia to flip assets overnight, right? So I think once we get over some of the hurdles that we faced, it will continue to be. It's a volume market, 127 million people, second most populous country in Africa. Okay, and I actually saw a very interesting thing a couple of days ago. There's a McKinsey report that says the most productive, the fast lane productive economies in the world, the top 6 of the last 25 years, Ethiopia has been number 3 after China and India. So even on the productivity side, so a lot of the elements, but I want to make sure that people understand also that I know this is an FX webinar, but I will reemphasize what I said at the opening in my monologue, that we need to look at the totality of the reforms that are happening, the opening up of sectors, this telecom sector, the banking sector, the retail wholesale sector, and one thing I forgot was the transport logistics sector. All these sectors are now opening up to investors who come to Ethiopia. These were closed until very recently. So If you look at it then holistically, I think Ethiopia will continue to be even more so attractive to FDI. Will there be challenges? Is there a learning curve? Absolutely, like anywhere else. But I see if I were to put money in Africa, anywhere else in Africa, and I'm looking for volume, I'm looking for the next China, I don't think you can miss Ethiopia. It should be the place to park your cash.
And I think that's a good place to sort of end the general discussion and allow a couple of questions in from the Q&A in the last 5 minutes or so we have here. So the first one is from Mark O'Sullivan from IPT Africa. And the question is, what opportunities do you see for NBFIs, non-bank financial institutions, to operate in this new system? I will open that up to the floor.
Should I take it?
Go for it.
Well, as you know, there's a strategy called Digital Ethiopia 2025, which is trying to transform, which is designed to transform a paper-based, cash-based economy into a digital economy. And I saw some numbers. The first 6 months of this year, digital transactions have actually exceeded cash transactions. And it's just getting started because it's only been 2 years. So the answer to the person from IBT, Africa, is focus on fintechs, the digital economy, how you can support that through introduction of new technologies or modifying whatever technology works somewhere else to the Ethiopian market. I think that'll be my short answer.
Very succinct, and I don't see any other unmutes, so I think we can move on to the next question. This one comes from Mariam Ahmed. As an Ethiopian diaspora looking to establish a business in Ethiopia, how might the flotation of the birr affect my investment strategies, particularly in terms of currency risk and capital repatriation?
I think firstly, Ethiopian assets just got 50% cheaper. And made so they if you thought they were good in the first place, they're now even better. That's the first thing. When you get a liberalization of the banking sector, which they're moving on to, and the establishment of a stock exchange, you're going to make it much easier for investors to access the market. And you should stimulate a secondary market, which will also bring in speculators. And when you get that, you get much more liquidity. So I think things are definitely moving in the right direction. As we said, there's probably a long road ahead, but it's, you know, the investment environment is looking more positive than it was and better value.
Great. And I see you're unmuted. Did you want to chime in on that, or should we move to the next question? Okay, I'll take that as so we have one more question, maybe to conclude the Q&A, which is this comes from Anonymous. What lessons learned do you think the National Bank of Ethiopia should take away from CBN to avoid further weakness of ETB? And I think, Duncan, you touched on that a bit in terms of drawing that parallel. Would you like to react to that question?
I think these things need to be done quickly and decisively. Dragging it out is not a good idea. You've got to decide to do something and go for it. There will be consequences. It'll be difficult, but you have to be decisive. And to begin with, Nigeria were not, and then they were, and things went a great deal better once they completely liberalized and just said the market decides where the exchange rate is.
Right. I think we're just at the tail end of the call here.
Yes, thank you very much, Barkat, Patricia, Duncan, and Zamadene for your massively insightful exchanges. We could see that there were many who tuned in, so and for all the time. So I think it was really, really insightful. Thanks for all those great and wonderful insights that you provided. I think it's also valuable to mention that Invest Africa is a partner of the UK government's Growth Gateway program. And we would like to invite the Ethiopian businesses looking to export to the UK to actually reach out to us if you would like to discuss these opportunities, because Ethiopia is actually one of the priority countries, seeing that we're on this topic. So That then brings us to today's final part of the webinar, and we look forward to continuing these discussions at various upcoming events like UNGA, World Bank meetings, Africa Energy Week, and of course our trademark Africa Debate, this time taking place in the UAE on 31 October. So I hope that we can see you there to continue these debates. And for now, thank you very much to everyone, and we'll speak soon.